Last class, we have done a case study on BCG matrix. So after that, we just gone through what is the model of generic strategies. This again given by Porter. So he explained what strategy should be adopted by the companies in case the market is broad, in case the market is narrow. So explained about the concept of cost leadership and then differentiation. Then we looked into pest or pestle analysis. So next model, what we have to learn. Now, why are we learning all these things? See, we are learning all these things because at the time of planning for the organization, strategic planning takes up. So there are various aspects which the senior management or strategic management should be aware of. What factors affect the organization? How does what would be the impact, etc. What kind of a strategy should be adopted in different scenarios? So as part of that, this is the marketing model. But yet it has to be learned because see, when they come out with a plan to be implemented for a long period of time, see what other factors affect the organization also has to be known. So there is one model given by Michael Porter. He's a business theorist. He talks about the organizations have 5 forces of competition. So competition is from 5 different sources. So to name them, then he talks about the entrance, new entrants, the threat of new entrants is the first one. The second one talks about the rivals who are there in the market, that is the peers or the competitors in the market. So the kind of rivalry they face from the peers. The third and fourth ones are power of buyers and power of suppliers. The fifth one is the threat of substitutes. So we will be learning about this particular model in detail. So what are the 5 forces of competition? See the 5 forces of competition. The first one is a threat of new entrants. Basically, when we study about these 5 forces, we would be looking into what kind of a threat can these factors project, or is it really a threat to the business? Because sometimes the business may have an upper hand over these factors. In that case, so these theoretically they are factors that affect the organization, competitive factors, competitive rivalry. See, then again, maybe they do not affect the organization because of certain reasons. So when we study these factors, we have to understand whether it is really a threat or not a threat. From that aspect, we have to look into. Now, who are new entrants? There is a market where already players are selling their products. If a new player wants to enter into the market with his products and then wants to sell these products. As of now, the customers are all distributed among the existing sellers or the players in the market. When a new entrant enters into the market with the product, some of the customers, if not all of them or most of them, at least a few of them get attracted to the new product introduced by the new entrant. So that will affect the market share. Market share, it will also affect their sales, or in the sense, it will affect their sales and revenue and profit gets affected. So there is a threat from new entrants if a new entrant wants to enter into the market. So now, is it so that anybody will enter into the market? There are various factors which are favoring a new entrant, or there are no factors the factors are not in favor of new entrants. So sometimes government encourages various enterprises to be established in different areas, zones, etc. In such a case, if at all, if there is any support from the government side, then we see that new entrants enter into the market very easily. How does the government encourage them? By easing the registration process, licensing process, okay, the complicated procedures, whatever are there, they may be eased, and many people try to, I mean, find a way to establish their organization or their business, their company, start the business. If such an attitude is there from the end of government, then it is a threat to all the new end, threat to the present players or the sellers in the market from the new entrants. Okay, government may give a tax holiday, government may encourage, or by giving some subsidies, some grants are given. Then anyway the registration process we've discussed. So if that kind of an encouragement is there, then the threat is at its peak, very high, because many will find a way to start their business. If it is the other way around, if the registration, licensing and all this process is not so simple, it's not so easy, then in that case they don't enter into the market so easily. And another important factor is if the capital requirement is very high, then not many will come forward. So depending on what's the capital requirement, also we can see whether threat is present or not, apart from the role of government. In all these 5 factors, we see there is one common thing called as switching cost. What is switching cost? See, if the existing customers switch to a new player, there may be sometimes certain switching costs associated with that. What does it mean? Let's say if they are subscribers, so subscribers of a particular seller for a particular product, then they may be a subscribed member availing certain benefits, certain features. Certain features can be availed. Maybe the existing customers can avail a discount every time they purchase. There may be a discount given, or there may be certain features, special features like see if I mean, certain sometimes when the purchases are made, free delivery can be there, or first preference will be given. See, Amazon comes out with that. See, when the sale happens, first it is open only to the Prime members. Then the next day it is open to others. So likewise, many brands, many products first give importance, priority to their existing customers. So in that way, did I explain this model to you?
No, ma'am.
Okay. So in that way, then if they continue, they can avail. If they discontinue, they will not be able to avail those benefits. So to continue to avail those benefits, sometimes we see that the customers do not prefer to switch to other products or other sellers or other companies, so other brands and all. So if switching costs are present, in that case, we don't see them easily switching to other players. So in that case, the threat is not there. If at all, if switching costs are there, the threat is not present. Then economies of scale is another point. The economies of scale talks about as the production increases, it becomes cost effective. We know that particular concept. See, as the production keeps increasing, the cost per unit comes down, because fixed cost does not increase proportionately with the increase in output. Whereas on the other hand, we see that variable cost increases proportionately, but that's only one cost increasing proportionately. Fixed cost does not increase proportionately, or it does not increase until they reach the maximum capacity. So more number of units produced, it becomes cost effective. So the cost per unit comes down. Which is not possible. So when the cost per unit comes down, selling price also can be reduced. So that is one aspect. Generally, we see that in the initial stages, the products are priced high, but after a while, there is a reduction in the prices of many products. Uh, that is a regular feature because of the economies of scale. So already established sellers and players can afford to bring down their price, which is not a possibility for the new entrant, because the new entrant still has to touch the break-even point. Only after crossing the break-even point that the possibility of profit would be there. So in that situation, we see that it is not a possibility for new entrant to bring down the selling price or to realize the economies of scale. So if an economies of scale are there, it is not a threat from the new entrant. Then we see that there is a concept called as learning curve. So learning curve, you must have learned in PM or some paper CPM, etc. As the production increases, the amount of time taken by the labor reduces. So when the time taken reduces, then we see that the cost also reduces. So it becomes cost effective on account of learning curve. The existing sellers might have worked a lot on product differentiation. They might have worked on research and development, added more features. So they may be differentiating their product with advanced features from the uh, I mean advanced features as compared to the products of the new players or the other players. So that's another reason. So likewise, we have to look into various aspects and then understand whether anything is a threat. See, any of these factors can cause a threat from the new entrant or not. Okay, so what advantages does the existing seller has over the new entrant that new entrant cannot project a threat to the business? So from that aspect, we have to look into that. Second one is the rivalry among the competitors. So already competitors, they must be sharing the market revenue. So each one of them may have a particular percentage of market. So are the other competitors a threat to the existing business or not, also has to be looked into. Here as well, we can see the switching cost is applicable. Apart from that, certain other factors like, see, what's the portion of the fixed cost which is used by each company. See, we already know that concept. See, when this is fixed cost starting from zero number of units till the maximum capacity. See, until the fixed cost is recovered, see, this is total revenue, and we see this is total cost. See, till both the revenue and the cost curves meet each other, there is no possibility of the fixed cost being recovered. So now this is the point of break-even. At the break-even point, the total fixed cost is completely recovered. Beyond the break-even point, it is possible to earn profit. So now the extent of rivalry, one of the factors which can be considered to determine the extent of rivalry is what is the portion of fixed cost in their total cost. See, until the fixed cost is recovered, they do not take up any strategy to experiment with their prices or other ways. See, here, first criteria is that they have to meet the break-even point. They have to cross the break-even point, touch at the break-even point where the fixed cost is completely absorbed. Beyond the break-even point, it's only the variable cost. Therefore, they can come out with competitive strategies like bring down the selling price because the only variable cost is incurred. So such kind of strategies can be thought about by the existing players in terms of fixed cost. Then another important aspect what we can consider is, are the competitors into diversified businesses? See, if the competitor is into diversified businesses, then in that case, they may not be able to completely focus on one business. So the competitive strategies taken up by such businesses are on the lower side. They do not compete so severely because their focus is distributed among many products and services which they are offering. So the extent of rivalry is also determined by whether or not they are into diversified businesses. Another reason about competition, each one of them have a market share. So now if they have to grab the market share or um, get the market share or from the competitors should become weak or they should exit the market. Then their customers also will become, I mean, the competitors' customers also will become their customers. See now, sometimes we see that some of the businesses, though not doing very well, some companies they do not do very well in terms of profitability. They still continue to survive or exist in the market. The reason is, if they exit the market, some of the nothing can be recovered, but some of the overhead costs will continue to be incurred. If they continue in the market, at least their fixed cost or their overhead cost will be recovered from the revenue that is generated. Not with an intention of maximizing profit, but with an intention to recover the overhead costs. Some of the businesses, though they are not doing well, they continue to exist in the market. So in that case, the market share is divided among all the competitors. So it becomes difficult to capture their customers, or because they're maybe their focus is only to recover their overhead costs. So that we call that to be as exit barriers. So they want to leave, but there is a barrier that if they leave, their at least whatever overheads which were otherwise recovered will not be recovered. So with that intention, they continue to survive, exist in the market, okay, with an intention to recover the overhead cost. Okay, so these are the factors under competitive rivalry. When did they start? How ahead are they as against their competitors? So what product differentiation do they have to offer to the customers, etc.? These things also determine about the competitive rivalry. After that, we see that third and fourth factors are the power of buyers and the power of suppliers. Just one second. Now we see the third and the fourth factors, the power of buyers and the power of sellers. Sellers or the suppliers. Suppliers are those that supply raw material to the business. Buyers are the customers who purchase the finished goods from the business. So we can see that sometimes these two entities, the buyers and the sellers, suppliers, they become powerful. The reason is the dependence of the business on them. Let's say first the suppliers from whom the raw material is purchased. If let's say the raw material, a major portion of the raw material is purchased from one or few suppliers, then supply dependence on suppliers increases. So when they dependence on the suppliers increases, they have that bargaining power, because the company is dependent on them for the purchase of raw material. So they become powerful, their bargaining power increases, or sometimes certain kind of rare material which is required is supplied by the supplier, or a major portion of the raw material is purchased from them. Then the dependence increases. Then they can become very powerful. So is the case with buyers also. A major part of the major part of the finished goods that are produced, if that is purchased by few or one or few customers, then the customers become powerful. So then they can have the bargaining terms and conditions, the bargaining power with all their terms and conditions about what would be the price, what's the quantity that would be purchased, when should be the time of sale or delivery time, etc. All these aspects they start dictating terms to the business, so they become powerful. In that case, the key point here is dependence on these two parties, that is the suppliers and the buyers. They become powerful because the dependence is to an extent that they cannot do without these suppliers or buyers. That's when they become powerful, and then they start dictating terms. So in that case, to deal with these two parties, there is a concept called as integration. What is the meaning of integration? See, in the supply chain, we see that supply chain is the sequence of activities starting from the supplier till the goods are delivered to the customers, and also after sale of the products to the customers, any kind of services that are provided. So all of them are in a sequence, in a series, one activity connecting to another activity. So we see that in the supply chain, there is dependence of each other on each person on the other person. So here, if in this case, if there is an integration concept taken up by the business, then what will happen? The power of the buyers and the power of the sellers can be reduced. We can look into this with an example. Generally, we try to understand this with the example of a baker. Let's say there is a baker who purchases raw material, which can be called as flour. Flour is the main raw material. Purchases this flour from a supplier, bakes the baked products, and these baked products are sold. Let's say it's the supermarket. So supermarket purchases all their baked products to be sold to the retail customers. So here there is a sequence of activities. There's a supply chain. Supply chain starts with the supplier supplying raw material to the baker. Supplier supplies the raw material to the baker. Baker in turn makes the finished goods and sells them, or the baked products, and sells them to, let's say, a supermarket. So the dependence is seen here. The baker is depending on supplier. The baker is also depending on the customer, that is supermarket. So instead of that, if the baker takes up integration, that is, if it goes backward and integrates. So backward integration, if he adopts the strategy of backward integration, it means to say that he would go back and make his own arrangement for raw material. So make his own arrangement for raw material in the sense he can produce a crop, make his own arrangement for flour instead of buying it from the supplier. So if there is ability to go backward integration, in that case, we see that the power of the supplier reduces. The business is no longer dependent on the supplier. So in this example, the baker now no longer is dependent on the supplier to purchase the flour, but rather the baker has made his own arrangements of producing the crop and then have his own raw material arranged. Then they are selling it to the supermarket. Supermarket in turn is selling to the retail customers. So instead of selling it to a supermarket, the baker can start his own outlet where he can directly sell all the baked products to the customers directly. So that would be like going forward and integrating, forward integration. Backward integration, ability to make the arrangements for raw material. Forward integration, ability to move forward and attract the customers and sell the products. So if we look into integration, backward integration and forward integration, then we have mentioned that see, the baker is not now dependent on either the buyer or the supplier. Therefore, he can be relaxed about that, and then the power of the buyer and the supplier can be reduced. So on the same note, we can also think from the supplier's point of view. Supplier, instead of supplying the raw material to the baker, supplier himself, if he goes forward, makes his own arrangement to bake the products. So the ability of the suppliers to consider forward integration, and then that will become a threat to the business, because now the supplier will not be supplying any raw material, but he himself will make the baked products and directly sell to the customers. Therefore, the threat increases. If the supplier considers forward integration, then the threat increases. Okay. Similarly, the supermarket in our example here, instead of buying the finished goods or the baked products from the baker, the supermarket also can consider about baking the products all by themselves. So the supermarket, if the supermarket considers anything like making their own arrangement for a bakery, bake the products, and they themselves sell that to the customers, then in that case, a threat from the buyers in terms of the buyers backward integration. Okay, so we have to look into what's the power of buyers and the power of suppliers. Finally, we see that the fifth factor is threat of substitutes. Threat of substitutes talk about substitutes. Whenever we talk about it, basically depends on the the taste and preferences of the customers. If they are okay with using a substitute product, then we can see that that is a threat to the business. If they are very particular about not using the other substitute products, then there is no threat. See, people who drink coffee and tea can be explained as the best example for substitutes. See, some of them are very particular. Those that have coffee always prefer to have coffee. Those that prefer to have tea always prefer to have tea. Okay. If they are okay, those that are okay with having tea, then in that case, the threat from substitutes is present. If they are not okay, if they are very particular about having their own product, their own choice, very particularly, then the threat from substitutes is not present. Also, we also have this concept about switching cost applicable. So sometimes the customers continue with a particular uh, product, service, brand, company because they do not want to forego the shipping cost or the benefit of shipping cost. For that reason, they continue to survive in the market, and that can cause a threat to other businesses. One second, I'm opening the Excel file, so it's taking time. We'll do one case study. Sorry about it, it's not opening. So I'm just trying with this one. There is a case study based on 4 to 5 forces. So let's take it up and then Okay. There's a case study given here. We will answer this one. We'll read through that and then I'll take this to the Excel file. And from the Excel file, we can consider how to answer the questions related to Porter's 5 forces. So the questions that are given, see, they are based on using Porter's 5 forces. The first question is for 16 marks. The second one is what are the problems defining the market share? Then this appetite of the venture capital. So this is an exclusive case study based on Porter's 5 forces of competition. So we see that there is one company, Stokeness Engineering. Stokeness Engineering's mission is to provide world-leading reduced emission, fuel-efficient products for the motor industry in order to optimize the shareholders' returns. Stokeness has existed for only 5 years and is owned by its management and venture capitalists. So there is something about venture capitalists. We have to focus on venture capitalists. So owned by its management and venture capitalists. The management were all engineers who had been working on the basic research associated with new fuel technologies and saw the opportunity to commercialize their expertise. Stokeness is highly regarded in the industry for its advanced, efficient fuel cell designs. As a result, the VCs were eager to invest in Stokeness and have assisted by placing experienced managers into the business to aid the original engineering team. So the first paragraph gives us the introduction about what is this business. They are into providing world-leading reduced emission fuel-efficient products used in the motor industry. They want to optimize the shareholders' returns like any other business. This has existed only 5 years and is owned by its management and venture capitalists. Who are venture capitalists? So the minute we see a term like venture capitalists, we have to think about who are venture capitalists and then what is their role. Who are venture capitalists? Those that come forward to fund the businesses, businesses who cannot find finances or who cannot make finance arrangements or the financial institutions, they do not come forward to extend loans to businesses. In such case, VCs come forward to invest in the business. What's the reason? See, when they come forward, see that is they are willing to take up the risk that is associated with the business, the nature of business, so something which is innovative, which is not a regular one. So in that case, the regular financial institutions may not come forward to extend the loans. So in such case, VCs come forward. So the other aspects of VCs are, yes, they do come forward to extend the loans, but in return, they expect a percentage of equity. So then they also become the owners of the organization by taking a percentage of equity. Mostly we see that it could be around 30% of the equity is given to VCs. So on account of that, now it is not only owned by the management, the owners of Stokeness Engineers, but it is also owned by the venture capitalists. The management were all engineers who had been working on the basic research associated with new fuel technologies. So these group of engineers, they must have perceived this concept. They must have thought about it. So the management were all engineers who had been working on the basic research associated with new fuel technologies and saw the opportunity to commercialize their expertise. So, but now we also see that VCs are part of the management. Next Stokeness is highly regarded in the industry for its advanced, efficient fuel cell designs. As a result, the VCs were eager to invest in the Stokeness and have assisted by placing experienced managers. So, who's managing? So, their managers, experienced managers are placed. So, they also participate in the management and decision making of Stokeness Engineering. Okay, managed into the business to aid the original engineering team. Then we see new product development. The next paragraph, if we look into that, Stokeness is developing hydrogen fuel cells for use in powering large motor vehicles such as buses and trucks. They will replace standard petrol diesel engines. The fuel cells have a clear advantage over these older technologies in having lower carbon dioxide, a greenhouse gas emissions. Okay, the governments of many developed countries are keen to see cuts in such emissions and are supportive of a variety of possible technological solutions to these issues. That is, such as fuel cells, electrical batteries, and compressed natural gas. So we can see that there is encouragement from governments of various countries. Many developed countries, governments are encouraging them for their innovative ideas, their products, as they emit less amount of carbon dioxide, etc. Then we have another aspect, which is the external business environment. In case of external business environment, we see that external business environment, it takes 5 to 10 years to develop a viable product for sale in this motor market. There are a number of companies developing fuel cells, but Stokeness is believed to have a 2-year lead over them, to be only 3 years away from commercial launch. So they are the initial leaders to start this kind of a business. So they are ahead of their competitors. It is believed to have they have a 2-year lead over them, and to launch the product, so they're just 3 years away from the launch. Then alternative power technologies like the hydrogen fuel cells would be fitted by the major international vehicle manufacturers into their vehicles for sale to their customers. The vehicle manufacturers will need to form a close partnership with any engine producer in order to make their technologies compatible, and this has already begun to happen, with two of the major manufacturers signing deals with other engine makers recently. So we also have the concept of the power technologies which are used like hydrogen fuel cells. They have to be fitted by the major international vehicle manufacturers into their vehicles. So at the time of manufacturing of the engine itself, these cells have to be fitted into that. So now they have to have an agreement arrangement with the manufacturers. Okay, the vehicle manufacturers will need to form a close partnership with any engine producer in order to make the technologies compatible. See, I don't know whether you remember, but initially when these smartphones were launched, see, there were no, rather we can say there were hardly any or absolutely no apps built into the smartphones. Any app which had to be used, the user was downloading it from the internet, so from various sources. Only on downloading the app, they were able to do that. But of late, the newer versions of the mobile phones, we see that some of the apps are already built into the mobile phone. So there must have been some kind of an arrangement with the app owners that their apps would be installed into the mobile phone. So now such is the kind of arrangement here they would want to have with the engine manufacturers. So once the engine manufacturers have these things built into their engines, then it would be easy. So to have that such kind of facility, the engine manufacturers and Stokeness Engineering, they both have to have some kind of an arrangement. Okay, they would sign some agreement that at the time of manufacturing the vehicles, these kind of cells, whatever are used, would be taken from Stokeness. A major problem, look into the question, a major problem which needs to be overcome with any of these new technologies is that there must be an infrastructure accessible to the end users for refueling their vehicles. As the petrol station chains do not do for petrol engine vehicles at present. So, installing this particular cell in the engine is one aspect. After that, see there is a problem which says that there is not there's no infrastructure accessible to the end user. So whenever they want to refuel their vehicles, such kind of facilities to refuel their um, these cells which they would be putting into the engine. Okay, so refueling infrastructure is not present. Governments have indicated their desire to support the development of such technologies to address environmental issues and to try to establish new high value industries in their jurisdiction. They may do this through tax breaks and investment to support the development of the refueling infrastructure. So we can also see that government's role, government support is there, has indicated their desire to support the development of such technologies, because the environmental issues also have to be dealt effectively. After that, we see production of Stokeness fuel cells uses a special membrane which requires rare and expensive elements. Also, it has partnered with two other engineering firms to subcontract the production of certain components in their fuel cell. Stokeness has had to share much of its fuel cell designs with these firms in order to overcome certain engineering difficulties. Also, there are a number of startup companies developing the other technologies mentioned above, as well as large existing diesel and petrol engine manufacturers who are constantly reducing the emissions from their existing engines. The VCs have stressed the need to analyze competition and competitive advantage in order to understand how to make the business profitable in the long term. The CEO of Stokeness wants to understand the external business environment and its effect on performance management. So let's take this question to Excel file, and we'll answer this question in the Excel file. So if we see the first question says using Porter's five forces model. Using Porter's five forces model, assess the impact of the external business environment on the performance management of Stokeness and give a justified recommendation of one new performance measure for each of the five force areas at Stokeness. So we have to talk about these five forces and what impact these five forces have on the business. That is what we have to identify. Apart from identifying what kind of an impact each of these five forces have on Stokeness Engineering, we also have to give a suggestion as to one recommendation on one new performance measure. So that also has to be given. So it is a 16 marks question. So there are five forces. So each of them, even if 3 marks are allotted, plus one overall professional mark, it is allotted. So we should be able to address all those five areas and then score marks. So let's start. What is the first force? The force from, what is the first force? What is the first force?
Threat of new entrants.
You're there. Thank God. So the first force is threat of new entrants. So let's analyze this particular situation. We need to find out what impact does each of these forces, these factors have on the business. So what is the impact? Can you contribute anything? The new entrants is, can they be a threat to Stokeness Engineering? That first we have to analyze. It usually takes 5 to 10 years to develop a viable product. So immediately we do not see any kind of a threat because it takes a very long period of time. They have to enter into the market, then they have to capture. See, it takes time for them to establish any business, even for that matter, Stokeness Engineering is also 3 years away from their launch. So technically, when we look into that, there is not so much of a threat from the new entrants in that aspect because of the time period. But any other factor do we see that it can add to the competition or the competitive threat? What's the role of government? What's the role of government? Is government encouraging? Please answer. Is the government encouraging this kind of businesses? Who all are there? Abhishek, Afshan, Praveen Afshan.
Yes, ma'am.
So, do you understand the role of government in this? Not in a mood to do a case study. Other two are not even responding. Maybe they logged in and then left the class. Shall we do this next week? Case study? Because you people have to contribute the points. Then only it will be a discussion on case study. If I am only giving the answers, it doesn't make any sense. Shall we do the case study next class? In the next class?
Yes, ma'am. We'll do next class.
Okay. So the next topic, I hope you understood the concept. Those that are listening, I hope you understood the concept of 5 courses. Are you free in the morning that we can have a class in the morning? Are you free in the morning?
When, ma'am?
Saturdays. You have some other class?
Yeah, ma'am. We have other classes.
Okay. If you're free, we can have it on in the morning. That's the point. See, after for this 5 courses of competition, then we look into the influence of stakeholders. At the beginning, when we were talking about strategic planning, in the initial classes, we were looking into that, and then there are 3 different types of analysis that have to be taken up. One is the internal analysis, the external analysis, and the stakeholder analysis. All the 3 types of analysis have to be taken up. So now we've come to the point of stakeholder analysis. They have also to be considered. They have to be taken seriously about that. The influence of stakeholders. Who's a stakeholder? If we talk about who's a stakeholder is either is an individual or a group whose interest lies with the organization. So we call a stakeholder someone who's interested in the affairs of the organization. There are many stakeholders. Internally, we see the employees are stakeholders, the management stakeholder. Then we see there are connected stakeholders like suppliers, businesses, the investors. They are all connected with the business. Okay, by supplying raw material, by purchasing the finished goods. Then we see the investors investing into the business. They are all connected with the business, so connected stakeholders. Then anyway, we have the external stakeholders like the government is an external stakeholder. There are many other entities like the competitors, the general public. They are all stakeholders who would be looking into the affairs of the business, whose interest lies with the business. They are seeking information from the business so that they can take their decisions. So the decisions are dependent on the information available from the organization. So they are interested in the affairs of the organization. So now the influence of stakeholders, there is one model given by Menlo. Menlo talks about what kind of a strategy should be adopted. What kind of a strategy should be adopted in terms of dealing with the stakeholders. So the strategy that should be adopted. So while explaining this, he talks about 2 variables. One is the stakeholder, the power of the stakeholders power. So that's placed on the horizontal axis. Stakeholders power. The other one is probability of exercising power and level of interest is the other variable placed on the vertical axis. See, on the horizontal axis, stakeholders power is on the lower side. Then we see it is high. Then the power, see, sometimes some of the stakeholders are powerful, some of them are not powerful. On the lower side, on the higher side. So on the left side, we have it as low stakeholder power. On the right side, we see that it is high stakeholder power. The next one is the power of the probability of exercising power, or to what extent they are interested in the affairs of the. So here we also see that the power of exercising power or level of interest on the lower side at the bottom and on the higher side at the top. Considering these four scenarios, so it is this particular model talks about what kind of a strategy should the business adopt in dealing with the stakeholders. See, the stakeholders are less powerful. Their power is on the lower side. Stakeholders' power lower side. Then we see that their interest is also on the lower side. They're not interested as to what's going on with the company. Sometimes we don't see any kind of interest coming up from the stakeholder side. So stakeholders, as it is, their power is on the lower side. Then their interest is also not there. They are not bothered as to what is happening with the company, what decisions they are taking. All that also they are not interested. So that's one combination. So if that is the situation, as it is, they are less powerful. Their power is on the lower side. They are also not interested. So they cannot do anything as such to the company. They are also not interested about any kind of an information from the company. So such stakeholders can be ignored. If their power is low, their level of interest is high. Sometimes we see that as such by themselves they cannot do anything, but because of their high level of interest, they can instigate others. They can instigate others to take any action against the company. Like maybe they themselves cannot do anything, but they can approach the trade unions. Trade unions are powerful. So if they take a decision that can have an impact, they may approach the media, press. Okay, they can approach various groups like environmentalist groups and others, so who fight for causes, etc. So the stakeholder by himself or themselves, though they are not powerful, they can influence someone who's powerful. Okay. So if that is the situation, what should be the strategy? So whatever information these people who are seeking, who are interested in the affairs of the organization, the strategy that has to be adopted here is keep them informed. Whatever information they are seeking, provide them. Then comes the stakeholders whose power is on the higher side. They are powerful. Okay, they are powerful for this reason that they are powerful. All of them have to be kept satisfied. They are powerful. Any action that is taken against the organization, that can have great impact on the business. Therefore, for that reason, keep them satisfied. In both the situations, keep them satisfied. See, their level of interest, though it is low, at the moment it may be low. They may not be interested in the affairs of the organization. It may be on the lower side level of interest, but the important key point here is they're basically powerful. Any time they can take any action against the organization. So the very fact that they are powerful should make the company take such stakeholders very seriously. So keep them satisfied. Whatever they seek, whatever kind of information they want, provide it to them. So that's about the stakeholders' power on the higher side and on their interest on the lower side. Let's say both these variables, that is the stakeholders' power is high, the level of interest is also high. In such a situation, okay, um, they such kind of stakeholders are called as key players. They're called as key players. Give them most of what they want. So provide them whatever they are looking at and keep them satisfied. See, any decision which they take against the organization, it can have a very great impact. So provide whatever information they are seeking, whatever they are looking at, and give them the most of what they want for both the things at the higher point. The next topic here, what we have is ethics and corporate social responsibility. The ethics is, we talk about the business ethics. So, what are ethics? Ethics are ideas about right and wrong that set the standards for conduct. What is CSR? See, the main stakeholder here, or the major objective or the primary objective of organizations, for profit seeking organizations, is to maximize the shareholders returns. So that's the primary objective, but then again we see that there may be secondary objectives also, or sometimes their primary objective is not to maximize shareholders return. That is also a possibility. So when the primary stakeholders, that is the shareholders, uh, are not given the importance, the objective is not to maximize the shareholders profit, but to provide some benefit to other beneficiaries. The other beneficiaries could be like employees are given importance, customers are given importance, the relationship with the suppliers matters to them. So in that case, any kind of a decision that is taken is providing benefit to other beneficiaries, other stakeholders. So in terms of corporate social responsibility, when the company does something for the benefit of other beneficiaries, we call that to be as corporate social responsibility. Corporate social responsibility, this is when a company does more than the legal minimum that they are entitled to. So example given here is maybe pay minimum wages, or add value to the customers, bring down the price, build up a strong relationship with the suppliers, follow all the rules and regulations to adhere to the environmental compliances, etc. See, when other beneficiaries, other stakeholders are given importance and certain benefit is provided to other beneficiaries, then that will be referred to as corporate social responsibility. When the corporate takes the responsibility for the society, the stakeholders in the society at large, or a part of the society, or one group of beneficiaries in the society. So then that can be referred to as corporate social responsibility. See, as such, the direct question may not be asked here, but certainly in the case study, one part of it can be addressed towards corporate social responsibility. Because in SPL, corporate social responsibility was dealt in detail. So the questions are about CSR in detail for a full length case study would not be the scenario, but it could be built into the case in such a way that one part of the case is dealing with corporate social responsibility. So maybe your advice, comments, criticism, etc. So those things also have to be dealt with. In terms of if we are to deal with criticism, then criticism, see, when the organization's primary objective is to maximize shareholders' profit, any activity about CSR taken up can have an impact on the profit that is available to the stakeholders. Let's say if there is value added to the customer, so maybe they added more quality, more costs are incurred. So in that case, the cost increases, the profit decreases. See, they are also giving importance to the customers by adding value to the customer. So that can come in terms of um, the giving importance to the best features, adding quality to the products, which comes at a cost, which comes at a price. So that may have an impact on the overall profitability of the business. So that is a major criticism here. See, when they are established to maximize the profit of the shareholders, and that taking up any other activity is not going with the primary objective of the organization. See, we have discussed about pest analysis. So, pest analysis, the economic factors, the impact of macroeconomic policy on businesses, influences level of aggregate demand, the demand for products and services. Then we see influences the cost of business sector, that is exchange rate, tax rate, interest rate, etc. So in the economy, what's the scenario? What is the demand for goods and services? What is the employment rate? What activities are taken up to enhance the production, the productive activities that are to be taken up? See, what is the role of government? Does the government also invest their funds into the production of goods and services? So by producing more goods and services, there is employment generated, then there is income generated. So that is a cycle which goes on. So that can have an impact on the other aspects, the income level available, disposable income, etc. So these are all economic factors which have to be looked into. Then we see that the impact of the interest rate, inflation rate, taxation rate, the exchange rates. See, these things all have an impact on the business. Apart from economic factors, you also see government regulations. Government may come out with regulations about what are the competition policy. So are there any kind of an unfair trade practices? So those are curbed down. Then supply side policies. Um, see, is there any? Is there free supply of goods and services, or is there any kind of coding of goods? So supply side policies are to be looked into. Then we see green policies or externalities, uh, anything to do with environmental issues, and then protect the environment so that there is less impact of the pollution or the policies that are taken up by the company on the environment. So role of government or the policies and rules and regulations about various aspects. So the government regulations should be looked into. Now we now come to the end of the first section. At the beginning, I have mentioned that there are 5 sections. The syllabus is broadly divided into 5 sections. The first one talks about strategic planning and control. Next one is risk and uncertainty. Then we see performance measurement, information systems, and development in technology. So we have come to the end of first section and at the beginning of the second one. So risk and uncertainty is the next one. You there with me?